Welcome to Monday's Market Options Outlook here at T3 Live. Matthew Buckley, the Chief Options Strategist. And real quick, folks, we are almost full. Great weekly options live training session this morning. We put on a Twitter bull put spread that Mark Sperling put out in his Sperling trade of the week, and we also are looking at nearly $2,000 in profits on the SPX bear call spread that I sent out Wednesday night, I believe it was, to all of you that attended our live training session. So a nice nearly $2,000 gain, about a 70% return on risk in 2 trading days. If that's something that puts a smile on your face, I don't know why you're not on board yet. Go to t3live.com/weekly-options. Again, we're almost done here. I think we're going to wrap up this promo and close the doors because, again, we don't like a zoo, or I don't like a zoo in my live training sessions. Like a nice tight squadron so I can answer everybody's questions. And we did release a multi-payment option for those of you who wanted to spread your payments out a little bit. Obviously, the annual, just right out of the gates, a hell of a lot cheaper if you want to do the math on your own, knock yourself out. But the 4-pay is now available, and I strongly recommend you get aboard. I mean, that one SPX trade could have potentially paid for an entire year of your training. So if you can't recognize that this is a pretty good deal, can't help you out. Very interesting. Of course, Apple's, unless you've been on the other side of the moon, Apple, had a record opening weekend, and here comes the giant vampire squid saying the iPhone effect on retail sales may disappoint. Apple sells more than 10 million new iPhones over the 4 weekend. Cook, sales exceed expectations. A year ago, how many? 9 million iPhones were sold in the first weekend. So here you go with conflicting, again, monkeys can throw darts at the Wall Street Journal and pick stocks and probably do better than some of the people at Goldman Sachs or the Wall Street Journal. So our Apple trades are looking very well. Market's rolling over a little bit today. Why? Asia. This is pretty funny too, because last week, based on those horrific industrial production numbers coming out of China, the FXI actually didn't implode, and the Shanghai, kind of held its own. Why? Because everybody and their mother believe that, oh man, things are going so bad that the PBOC is gonna have to act. Well, over the weekend, there was a G20 meeting down in Cairns in Australia, and more or less the general flavor was, and all these central bank chiefs said they were close to adding about $2 trillion to the global economy, quote unquote, to create new jobs. But you know what? The low note, I guess, out of the meeting is Europe's extended slowdown. It is a pretty big stumbling block, but remember, folks, that Mario Draghi is Mr. quote-unquote, I'll do whatever it takes to save the euro. So he's got a fiat full of euro that he can pump into the system. He's got a lot more bullets in his gun than the Bernanke and Ms. Yellen had in our Fed gun, okay? But again, the Shanghai's getting imploded this Tuesday's preliminary reading of the Chinese manufacturing sector is showing a potential more sign of a slowdown. So it's interesting that last week a sign of a Chinese slowdown was actually a little bullish because the market believed that the PBOC is going to come to the rescue. Well, this week with bad macroeconomic data out of China, it's bad news. So we're kind of in this weird transition point as we get out of bizarro market. Is bad news going to be bad news once again? Or is bad news going to be good news because the PBOC is going to come to the rescue here? So very, very interesting. And obviously, I think we got a little bit of a Alibaba hangover, to be honest with you. As far as the flight schedule for the week, today, and it's after a Fed meeting last week, all these Fed lieutenants run out to the nearest microphone and do the old, well, what we meant to say, was whatever. So we got a lot of Fed people speaking throughout the week. But one of the reasons the market's down a little bit today too is existing home sales imploded. They rolled over pretty hard, and the last months were revised down as well. Housing, folks, the housing sector slowing down isn't a good thing. And down here in Miami, South Florida, I'm kind of on the tip of the spear, and I could have written this report. I know it's slowing down, and that impacts everything, folks. Concrete, steel, trucks, gas, jobs. So a housing slowdown, I think, is another reason that's kind of given this market a little bit of a poke. On Tuesday, we'll get some mortgage info. Got another FOMC member speaking, Flash Manufacturing, and the Richmond Fed. another Fed lieutenant speaking. On Wednesday, new home sales. So as you can see, kind of the theme this week might be a little bit along the housing front. There's another Fed lieutenant speaking. And then Thursday, obviously, we get weekly unemployment claims. And then durable goods. This durable goods order will move the market. Core durable goods. Whenever you see the word core, it means X something. And this is X transport items. So if, McDonnell Douglas, Boeing comes in with, hey, we have 100 new 777 orders. Well, guess what? That's going to impact the durable goods numbers. It's the core one that we got to look at because it's X transportation items, okay? And then Friday, it's kind of quiet with some final GDP and revised University of Michigan numbers there. But well, Whiz, GDP won't that move the market? Well, GDP comes out in three types: advanced, preliminary, and final. The advanced one is really what moves the market. The preliminary and the final is like, all right, we're already looking at next quarters. Who cares about what the final one is? I think that print that had a 4 in front of it was a complete smoke and mirrors. I think this is going to be revised down, to be honest with you, as do most people, but I could be wrong. Finally, on a day like today, this is what a portfolio should look like. 2 blinding greens and some pinks, not reds, pinks. And the 2 blinding greens, one's up 88%, is a VIX bullish double vertical and our SDS hedge as well. You have got to have some hedges in your portfolio, folks. And we covered this in my weekly options live training session last week here at T3 Live. Look at that. The VIX is up 15%. Now, if you wrote down, I said this at the 4:30 briefing and I said it at the 9 p.m. briefing. When vol is cheap, you buy it. When it's expensive, you sell. Look, my line's still here. I said down here, it is cheap, and look at where we are. We're back up. After the Fed meeting last week and vol imploded, that's one of the reasons we did those training sessions on Wednesday. I said, folks, the market rallying on these Fed comments is a perfect time to get long vol. So hopefully you listened. Okay, got to run. Actually, heading to an airliner right now to head up to Vancouver, the Great White North. Going to be speaking to a large Canadian conglomerate. Love going up to Canada. They have some regional small intramural hockey teams that I like to make fun of because obviously I'm a Flyers fan. But I'll be doing our primary live trade brief tomorrow morning at 0900 Eastern. 060 dark 100 Vancouver time. Okay, again, folks, t3live.com/weekly-options. Nearly $2,000 gain in one of our trades in 2 days. So get on board, get airborne, do the 7-week training program, and I'll teach you how to trade options, or I'll die trying. Okay, happy hunting. Have a great rest of your day, and I'll be back with Tuesday's market sit rep. We'll see you.